Here's one you want to watch all the way through before the Federal Reserve meeting, because we've got three really important things that we've got to talk about before the Fed meeting. Number one, the disaster of the ADP jobs report that just came out. Number two, what JP Morgan thinks the results will be in the stock market after the Fed meeting, so what to prepare for. And number three, we've got another update from NickiLeaks, which is a reference to the person who basically gets text messages from the Federal Reserve and then tweets or writes stories about them at the Wall Street Journal. All right, folks, let's get into this. The first thing that we have to look at is the ADP report that just came out. Initially, when you look at it, it looks like a complete disaster. It looks terrible, okay? Because it suggests we gained 239,000 jobs in October and that the annual wage gain was 7.7%. Now, why is this terrible? It's terrible because of something potentially known as the wage price spiral, where if inflation is below the level of how quickly wages are going up, so if inflation falls to like 7.6% and wage gains are 7.7%, you potentially start having a wage price spiral, where the gains in wages become self-sustaining, spiraling to the upside because workers demand more pay as prices have gone up for goods, but then because workers demand more pay, prices of goods have to go up and you self-sustain inflation. And it never goes down, okay? Absolutely terrible. And on the surface, it feels like, oh no, this is absolutely terrible. We need to see this annual pay go down. But when we actually dig deeper into the report, we actually get what I consider some hope. Take a look at this. We suggest, or ADP suggests, that hiring was not broad-based, and we're seeing early signs of a Fed-driven demand destruction only affecting certain sectors of the labor market. Now, that's a big deal. So they're basically saying, hey, Fed, numbers on the headline bad, but we're starting to see y'all causing damage. And then things get really interesting, because when we actually look at this breakdown, we've lost jobs in a lot of sectors. Look at this, minus 8,000 jobs for goods producing. This is a shrinkage in jobs. Information down 17,000, 10,000 down financial activities, professional and business services, education and health services, minus for services. Lots of job losses here. Where are almost exclusively all of the jobs coming from? Right here, folks. Leisure and hospitality. This is really interesting because if we compare this to a separate ADP report, we could see that most of the monthly earnings gains between 2019 and 2021 are occurring in the group, the cohort of lower income individuals. And ADP suggests this makes sense, that lower income areas are seeing the lowest paid workers are seeing the largest increases of pay, in some cases as high as 42.5 or 42.4% pay increases since before the pandemic. So you're really seeing that lower end really see dramatic strides in wage gains. And the reason that's so important to differentiate is because if we gave the Fed this report and just said, hey, annual pay's up 7.7%, we might have a Fed that needs to rug pull us because these numbers on the headline are scary. It's only when we break them down and say, wait a minute, it's actually that lower income job sector. They're the ones who are getting the jobs, and they're probably the ones making up the bulk of the pay increase. And on top of that, we see that job gains for momentum and sort of these wage increases is starting to ebb. In fact, for year over year pay growth, we saw an edging down of pay growth for job switchers from 15.7% in September to 15.2% in October. But for people who stayed at their jobs, we're still consistent at that 7.7%. These are high numbers here. And if we look at median pay change by category, look at where, no surprise, the biggest pay change category is. So on the surface, we have bad news. But when we actually break it down, we're like, these are the lower paying jobs that are seeing most of the wage gains. and they're the ones that have been catching up most since before the pandemic. They really deserve to be getting the biggest pay bump because they've been so far left behind. And so hopefully, we have a Federal Reserve that, come Fed time here today, we have a Federal Reserve that either today or in the future starts realizing, hey, wait a second, we need to talk about this wage price spiral and identify it as what it is. It's just a one remaining sector catching up. The rest of the jobs market is starting to slow. Now, I want to talk about JP Morgan. We're going to talk about JP Morgan in just a moment, but keep that in mind. The rest of the jobs market is starting to slow. It's just leisure and hospitality that's booming. And quite frankly, if you look at Uber, if you look at American Airlines, you look at what American Express is saying, all of them are saying travel is still booming. That will eventually get hit as people draw down on their consumers. I don't know that you need a higher Fed funds rate to get people to stop traveling, because here's the reality. A higher Fed funds rate isn't going to affect people at their homes and their ability to travel like a higher Fed funds rate is going to affect a company that's trying to buy, finance a plane or finance new machinery or whatever, because most of those rates are directly tied to the Fed funds rate. With the consumer, they just use their savings, or they go from high interest rate credit cards to a personal loan over at SoFi. It's brilliant. Now, let's realize that is a good thing. We just need the Fed to realize raising rates more is not going to stop leisure and hospitality spend. We just have to let people spend their money, get through the holiday, and then realize we're in a recession, and then that'll slow. You don't actually have to be more aggressive. Now let's talk about JP Morgan right after a message from our sponsor, Established Titles. Some of you might not know, but I'm not a landlord anymore, and I'm a little disappointed about this because, I sold 85% of my properties, all the ones with tenants in it, and I'm not a landlord anymore. So now when people are like, but hey, Kevin, the New York Times has you featured as a landlord influencer, but you're not actually a landlord, like, what happened? I thought you were the landlord to go to with questions about landlording online. And I have to say, I was so disappointed. I thought, you know what? Maybe there's a way I could become a landlord again. And so what we did is we got ourselves 1 square foot of land in Scotland. And now we're technically lords of the land again. We have 1 square foot of dedicated land on a private estate in Scotland. We have an official certificate to go with it. And I'll show you that certificate, and I'm gonna take you into the special spot where my certificate is. See, my certificate features a unique plot number, so that way I can always geolocate my exact location. And the company that plots these plots and sells these plots plants a tree with every single order. So if you want to be a landlord, consider using the link down below, and you can officially change your name to Lord or Lady, like on your plane tickets and credit cards. There's some things you can't put it on, like passports and driver's license, sadly, but I'm officially a Lord again. So you can now go to establishedtitles.com/meetkevin to get your last minute gift for someone else. You get 10% off when you use the Meet Kevin coupon code, or you go to establishedtitles.com/meetkevin. What's really cool is Established Titles is running a large sale right now that's unique to this moment in time. So make sure you use that code MEETKEVIN to take advantage of that sale. And quite frankly, it's kind of cool to officially say I'm a landlord again. By the way, Established Titles told me the first 200 people purchasing a title pack using my link down below will effectively be next to my plot within a few minutes of walking. Depending on how many of you want to become a lord or lady, we can build our own little channel named Kingdom 93. Let me show you the certificate. Here it is, my certificate in my new podcast set. Don't tell anyone yet, but we are gonna hang this up so that way I'm officially a landlord in my podcast set. Let's go. So JP Morgan provides multiple outcomes for what could happen with the Federal Reserve. Let's take a look at some of these outcomes. So first, JP Morgan suggests there's a low likelihood of the Fed coming out with a 50 basis point hike. I agree. I think this is almost a 0% chance, but they suggest if the Fed turns dovish now, because for whatever reason the Fed flips and realizes, okay, we've done enough, let's slow, They think markets could rally 10 to 12%. Now, if the Fed goes 50 and is hawkish, which has a slight chance, I think almost no chance here, but is slightly possible, like already seeing a reduction in these rate hikes, in the pace of rate hikes, you could also see a substantial rally at the S&P 500. I don't think so. I don't think we're seeing that until December. Next, they think you could have a 75 basis point hike with a dovish press conference. They think this is the second most likely outcome. I personally don't think you're going to see a dovish Powell. I think we've got 2 jobs reports and 2 CPI reports before they could dare have this credibility challenge of having a dovish Fed Reserve meeting and then getting really bad data over the next 2 reports, right? Now, the ADP report has some levels of optimism to it, but again, you don't want to go into 2 jobs reports and 2 CPI reports with a dovish meeting and then look like an idiot, right? So I feel like you have to be hawkish. Anyway, dovish could lead the S&P up 2.5% to 3%, whereas unfortunately, a hawkish press conference and a 75 basis point hike, which is deemed the most likely outcome, could lead the S&P 500 down 1%. Now, you do have a 100% or a 100 basis point hike possible, but probably unlikely. But if we got a 100 basis point hike and a dovish Fed, or a 100 basis point hike and a hawkish Fed, you'd probably see either a 4.5% S&P decline or a 6 to 8% decline. It would be so unexpected, it would almost be deemed a rug pull by markets. Now, we're not expecting that though, and fortunately, we have NickiLeaks to give us a little bit of insight. Remember, this is the guy who always writes about the Federal Reserve. This is the guy who gets the text messages. And what is NickiLeaks telling us? Well, he tells us that the Fed is trying to tighten financial conditions and keep them tight. Notice keep them tight is really important because you could tighten to a certain level and then continue to keep pressure by talking hawkishly, right? And Mr. Nick here says that talk about the Fed pivot can be confusing because there are multiple ways you could see a pivot. You could see that raising rates rapidly to catch up is deemed somewhat of a pivot, right? You pivot to get aggressive, like what we saw at the beginning of last year. That would be a bearish pivot, right? Then raising rates at a slower pace is also deemed to be somewhat of a pivot. Then holding rates at a given level is deemed to be a pivot, going from raising to not raising at all. And then there's another style of pivot, which is just like the Fed going to straight out bailout mode, like a fourth pivot here, right? So there are many ways to look at a pivot. Usually markets bottom when the Fed does the fourth thing, which is when they U-turn. And rather than just doing any of these, they go, okay, we've done too much, we've caused too much damage, we need to support markets again. Like what, we've seen historically by the Federal Reserve following Black Monday in 1987, 2003 at the end of the dot-com bubble, February of 2009, December of 2008, and March of 2020. Those were historically the bottoms of the market, and they aligned with Fed massive U-turns, not even just pivots, like full-on U-turns. Anyway, like think of a pivot in like basketball, right? You do your dribble, you got your dribble, and then just pivot, like to the left, to the right. And like U-turn is like, okay, I'm out of here, full-on reversal. Anyway, derivatives market, Nick here shows that investors expect the Fed funds rates to remain at 3.5%. Dude, we're not even at 3.5% yet. That's crazy. And expect it to remain at 3.5%. We're close, but anyway. I expect it to remain at 3.5% for the long run, the highest level since 2014, as wages rise. And people worry that higher inflation will end up being structural, in other words, sort of built in and it's self-sustaining. So we'll see. We've got a lot of reports coming up, but here's my take. I really want to see the Fed make a clear distinction between the type of wage gains that we're getting, but I'd also like to see a clear distinction in the type of inflation that we're getting, that it's heavily based on the housing market's shelter inflation. Again, if you subtract shelter inflation from CPI, what do you get? You get no inflation. Now, I see some comments, people in the comments are like, oh, how could you subtract the single biggest thing of somebody's expenditures and say, see, look, inflation's zero. Because the way CPI is measured lags by 6 to 12 months. Rents are already coming down, but CPI still sees them as trending up, and CPI hasn't caught the inflection point yet. So it actually means that real renters today on the open market are getting better deals on rent than they were a few months ago, and CPI doesn't see it that way yet. So hence why some people call it the CP lie. Now, I know anecdotally a lot of folks like to come out and go, I don't know, man, it seems like rents are only going up. Just look at the data. The data says rents have already peaked. We're not going to go debate that here. We've debated that in plenty of other housing videos. So, my demands for today and expectations. 75 basis point hike. Hawkish Fed. He's got to hawk. He has to hawk. Because otherwise we're just going to loosen financial conditions and lead to a stock market rally. He doesn't want to rally yet. Let that come in December. Be patient. Then I'd like to see, this is my like to, so I expect 75 and I expect hawk. But I would also like to see some clarity on concerns around a wage price spiral and insight into CPI shelter inflation. And if we actually get those two things could actually be deemed dovish. And so you could see what sounds like a hawkish Fed turn dovish and bullish for markets. So I'm optimistic and hopeful, but remember, hope is not an investing strategy. Thank you so much for watching, and we'll see you in the next one. Goodbye.